We've got some great speakers this morning. We have God's Will in Wonkwo. I'm probably butchering that, I'm sorry, of Betaford, who will be speaking first. We have Ken Piddington of Compass 42, who will be coming along shortly after, and Katie Minert of Ally or Pink Petro coming afterward. The speaker we had last has canceled on us, so it's like a do-over of yesterday afternoon. But Gerald wasn't able to make it this morning. So I'm going to be bringing God's Will up here shortly. He serves as the president and CEO of an energy-focused private equity and project finance company. He currently works with his team and affiliates to build and deploy sustainable operational and financial strategies that are geared towards growing value in the short term and long term. These often include providing contract turnkey drilling, which minimizes the risks and uncertainties of time and cost, as oil field wells can be planned, drilled, evaluated, and completed to the client's specifications. God's Will has previously worked for Schlumberger, Halliburton, Baker Hughes Intech, and several national and multinational companies. Excuse me. God's Will has a bachelor's degree in mechanical engineering with a specialization in computational fluid dynamics, CFD, a master of science degree in computer science, with specialization in cognitive artificial intelligence. That sounds awesome. And an MBA in finance with specialization in private equity and investments. God's Will is also a candidate for president in Nigeria. I'm not sure if that means he's a blue state or a red state or whatever, but it definitely means we have a great speaker coming up. So come on, God's Will.
Hello, good morning, everybody. I'd like to welcome everyone this morning. But before I start, I'd like to thank Tommy Sam Miguel. I also like to thank Craig Hicks, Bad Vorsen, and the rest of the investor relations team. But most importantly, I want to thank the SGR Energy for bringing us here today. Today, I'm going to be talking about the returns optimization strategies in upstream assets. And we're looking at the current dynamics. The current dynamics currently in the oil and gas. We have the crude oil production forecast is set to decline until the mid-2021 before returning to current trends. Declining legacy well production will offset production from new well in the first half of 2021. And so as new wells begin to come online later in 2021, maybe the second half of 2021, the production will now exceed the legacy well declines. And legacy wells are the wells that are already in place that had not been added to the population. And this resulting in an increased crude oil production. So we're looking at OPEC and OPEC Plus, considering that they're looking to keep production at current levels. And this, with the forecast, looks like we're going to be seeing a higher crude oil and gas price by the middle of next year. Now, just a disclaimer, just to tell you that past performances or historical performances are not an indication of the future results for investments. Just a little bit about myself. Like I said, I have my degree in mechanical engineering with specialization in computational fluid dynamics. I also have a master's degree in computer science with artificial intelligence. I spent my early careers working overseas and working with Schlumberger, Halliburton, and Baker Hughes in all the basins from Bakken to Eagle Ford, from San Juan Basin to the Marcellus. And just for that information, I was also a research fellow at the NASA Research Center for Biotechnology and Environmental Research. I'm also currently the co-chair of in the board at University of Houston, and I'm on the advisory board for the American Association of Petroleum Geologists. I'm a board member of the Society of Independent Professional Earth Scientists. I'm also a moderator and member of the Financial Executive Networking Group, the FANG. So, Betaford, what do? We develop and implement robust models for complete port-to-pressure value chain. So when you look at the oil and gas, there is a discontinuity in the value chain sometimes, oftentimes, because you have different players or different participants coming in and out when you develop the value chain, or when you develop, the production from the pour all the way to the pump. So what we do is we come in and we provide contract drilling services, whereby we come and we bring the rig, we provide the services that is required to actually develop the assets, and we complete and we produce and we hand over the keys to the client. But all this we do at a fee. But the good thing about it is that if you operate oil and gas, you find out that most times when you develop your assets, there is a very strong likelihood that you overshoot your AFP, which is the cost, the budget that you budgeted for drilling the well. If we have situations where there's always a cost overrun whenever there's a drilling project, we bring the value to come in to drill the project or to drill the well at a fixed cost and minimizing the risk and uncertainties of time and cost. We also provide directional drilling, and which includes measurement logging while drilling, and we do drilling optimization, which requires us to perform operational studies and generate best practices and recommendations. We do production services and completion services. And of course, other value-add services we do is the oil and gas advisory, where we provide management and financial advisory for operational and M&A events evaluation. We also provide oilfield IoT, where we implement intelligent systems and technology to oil and gas workflows. And we do energy markets, energy assets and markets, where we provide the platform where you have a sales and purchase of cleared assets, and we provide portfolio management and securitization. Now, we've had speakers in the last day or so talk about the problems in the oil and gas. How did we get here? How did we get to the point we are right now, where we have companies filing bankruptcies, why we have lots of oil and gas companies going for restructuring? The question is, it's different. This time is different. And why is it different? Previous price collapse are usually followed by industrial rebound, and then business as usual, and then life goes on. But this time is truly different. Why? Because we have so many things happening at the same time. One, we have a supply shock with an unprecedented demand drop, which is accompanied by humanitarian crisis. So before, it's either there is a supply shock, an increase or decrease in supply, and all they do is to adjust the demand, or there's an increase in price or decrease in price, and then you play with the supply and demand to be able to get to the equilibrium price. But right now, with the multiple factors actually affecting the ecosystem, we see a situation where it is different, and the pain is being felt across the entire industry. So how did we get here? We got here because of the financial and structural health that has been lingering for the past couple of years, for the past decade or so in the industry. And this is due to the excessive supply, due to shale production, and the generous financial markets ignored the limited capital discipline that all contributed to poor returns. So I look at it like this, because I've been in the trenches and I've been in the middle of, this whole dysfunction for quite some time. When you see decisions being made about capital purchasing and capital investments, people tend to purchase or make investments based on their whims. I can give an example where there were times when we had to procure. When I wasn't part of the decision-making process by then, that was a long time ago. The decisions were made to procure a really expensive technology. There was no justification for that purchase. So what was the effect of that? They bought this technology because they felt that it was going to make the client, because the service company that I'm talking about in this particular case study, the service company figured that if they had a nice looking technology, a new technology that the client was going to give them more contracts or going to give them more wells to drill. But the problem is that for every well you drill, you're going to get paid the same amount of money. So your margins is going to pretty much stay the same. You kind of liken this situation like if you have a fixed paper route and you get paid the same amount of money for running that particular paper route. It doesn't make a difference whether you run the paper route with a Mercedes or with a Chevron, with a Chevy Malibu. So you have to figure out what would actually get you to that price point or to that cash flow with minimal expenses. And I had to sit down and tell these guys that we have to bring in tools, metrics, capital, investment tools that will help us make decisions in terms of investments. And this includes looking at the MPV, looking at the IR, and looking at the hurdle rates. Well, look at investors focused on growth funded by debt rather than operating cash flow and capital discipline. We also have situations where there was absence of fundamental change, which made it difficult to return to the attractive historical industry performance. Without these changes, without making the structural changes required, the industry could be entering in an era defined by intense competition, flat to declining demand, investor skepticism, and increasing public and government pressure regarding climate change. Let's face it, the oil and gas will remain a multi-trillion-dollar market for decades because it's portable, it's affordable, and it enjoys existing infrastructure. So it's too important to fail. Now, I've broken down the strategy on how to optimize the returns for investors. And one of them is, this is the 30-feet overview. One of them is consolidation. That consolidation allows entities that have weak balance sheets to come together to create a stronger balance sheet. And this would allow them to create that economics of scale and allow the basin masters to actually drive the efficiency in that basin. It allows them to harness accretive synergies because you see most of these entities, which are the small to medium size producing companies, they are actually duplicating efforts. They could create that accretive synergy if they come together and harness their common resources to achieve that particular goal that they are looking for. We also have one of the strategies is diversification. This will allow us to reduce idiosyncratic risk. It allows us to enhance risk-adjusted return. When we talk about risk-adjusted return, what are we talking about? You want to be able to get to that cash flow with minimum risk as possible. It's just like if somebody said, okay, how are you going to be able to get a, let's say you want to sell a piece of property and you have to travel at night to go meet whoever is buying that property or that piece of property. Now you have to travel at night, which is risky, or do you want to go and show the property during the day? So when you might make the sale, whether it's at night or during the day, but the question is, what risk are you taking to actually go to achieve that goal? And that is when you bring in the risk-adjusted return. We also have increased exposure and opportunity, which is equal to opportunity when you create that diversification in your portfolio. And then the third one is the fractional investing, which is actually a new form of capital, having capital assets by entities. And we have RegCF. The access to capital for this industry will be more efficient because there's more liquidity in the market. It allows investors to get in to the investment at low capital. And of course, the one that puts everything together is the managed portfolio, which involves building and overseeing portfolio. You conduct research in demand and supply forecasting, and of course, you benchmark your performance using Arova and Arovol. So consolidation requires, bringing the activity, consolidating activities and assets through a formal or loose joint venture. This could be joint development programs. They could be sharing technology, equipment, and workforce. They could be partnering on service agreements and other infrastructure. And of course, the benefits is improve the weak balance sheets of the entities, several entities that are looking to consolidate. The the value is created because of the economies of scale and scale, and allow the business masters to actually drive the efficiency. It allows you to adopt Internet of Things and data analytics. That will create that efficiency when you try to scale. Because at the end of the day, when you now bring intelligent systems into your ecosystem, you can scale as much as possible. And of course, you will be able to harness a creative synergy. And it's estimated that this could potentially reduce the break-even points by about $10 per barrel. Diversification. So we have these two in portfolio management, in portfolio theory and practice. We have this tool that was developed by Deloitte, and it's used to create diversification in portfolio assets for upstream oil and gas. And it allows you to diversify. So this was developed in 2016 and is a framework that analyzes changes in upstream portfolio across 5 dimensions. One of the dimensions is fuel, region, resource, basin, and investment circle. And the benefits of this diversification is that it reduces idiosyncratic risk. Of course, it enhances risk-adjusted return. And of course, the increased exposure, and it creates opportunity. It safeguards against adverse market circle. And of course, it reduces volatility. Now, fractional investing for XCF. This is one of the new strategies for capital raise that was put in place recently in 2012 in the Jumpstart our Business Startup Act. So the basic idea is to aid small US startups company to raise capital from an extensive range of potential investors, as well as providing excellent investment opportunities for investors. Now, the benefit of this fractional investing is to, create access to capital, create more liquidity in the market, and of course, low capital for investors. And you can have investors invest as low as $1,000. Now, we are creating this platform. This platform is scheduled to launch in the next couple of weeks. And what we do is we currently right now we use our platform to facilitate the buying and selling of assets all over US land. And we figured out that we can do more for the industry, we can create more efficiency, we can bring more value to the industry if we can create a more robust ecosystem, a more robust system that would allow not just buying and selling of assets, which are just individual assets, but actually creating a situation where we can diversify the play, we can diversify the resources, we can select assets all across the United States by their different diversification criteria. And then we now set this up in various silos. We have the low risk, we have the medium risk, and we have the high risk. This allows us to securitize those assets and create funds. And of course, the low risk gives about 10 to 15 internal rate of return, and the dividend is distributed every 3 months. We have the one that the payback period is about 3 to 5 years, and we generate the cash flow from existing production. We also have one with the medium risk, which is about 15 to 30% internal rate of return. The dividend is distributed every 1 month, and of course, the payback period is between 1 to 1.5 years. In this one, we mix a combination of pods and existing production to be able to achieve that. And of course, we have the high risk, which is about 250% internal rate of return with a dividend distribution in 1 month. And of course, we have the payback period of about 1 to 1.5 years. And this is strictly exploration. And of course, we have the managed portfolio. The managed portfolio, this is the one that brings everything together and ties all the various component parts. This is the snake head of the strategy because it requires building optimal asset allocation. And this optimal asset allocation, you benchmark this allocation using the Sharpe ratio, which is the RVAR, which is a measure of the reward to volatility ratio. And of course, use another second tool, which is the Trenor's ratio, which is the RVAR, which is a measure of the risk premium per unit of systematic risk. This is implemented using a risk matrix from reserve classification. And reserve classification allows you to now define the risks for both the proved reserves, the probable reserve, and the possible reserves. And when you assign those risk matrices, you'll be able to now generate a model that would allow you to now continuously revisit your portfolio to make sure that you have the optimal portfolio at every point in time. Now, the managed portfolio also allow you to create hedging strategies, and you can use several hedging strategies, including forward contracts. The benefits of the managed portfolio is it involves building and overseeing portfolio. It allows you to conduct research, which of course is demand and supply forecasting. And of course, it allows you to benchmark performance. But most importantly, it allows you to incentivize the management team, because you can set PIPs, which is performance incentives, and ensure that you incentivize them to give you better production. Now, this is a screen capture of one of the assets that we're looking at a couple of months ago. This is an asset that was in Texas. It was supposed to be, if you look closely, I don't know if you can see that. It was supposed to be sold for about $50 million. And we plugged everything into our model, generated the matrix, allowed us to draw the forecast, and we came up with the valuation using our discounted cash flow to about $50 million for the valuation. Now, if you look at this particular asset is the target of return for this asset is about 28%. So that means that it falls within the medium risk. So we run all our assets and we vet all our assets through several of our models and several of these systems that allows us to classify those assets and ensure that they are actually delivering the returns that we expect. And with that, I'll open for questions.
Yeah, I saw that it said on one of the slides that you were either going to divest, invest, or retain, but retain should be a conscious decision rather than a convenient one. How do you enforce that?
So we know that in the oil and gas, we have the tendency to withhold dividends from shareholders. I mean, they believe that they have to reinvest, the net income. So the payout ratio, they try as much as possible to reinvest, to retain 100% of the net income. But that is not the strategy if you want to create that capital gain for your portfolios. You have to be able to, ensure that you provide that dividend distribution to your investors. And if there is any reason for you to reinvest those retained earnings, you have to be able to demonstrate that it will actually generate the required amount of return that the investors will be comfortable with. Because, and I can tell you this because it has happened so many times, in my experience, my 20 years experience in oil and gas. Operators are always hot about the new thing out there, without any concern whatsoever on how much value and how much net present value is going to bring to the company or to the entity. So so that's why we're creating this broad, robust model that would allow us to benchmark every decision we make. If we have to retain some of the earnings and invest them in, let's say we probably want to buy a new technology, how is that technology going to generate extra returns for the investors? We have to be able to demonstrate that. If we can't demonstrate that, if we can, first of all, we have to look at the NPV and the IRR. Of course, that's basic in terms of capital decisions, capital investment decisions. But we have to be able to ensure that the investors are comfortable with the idea that we are getting $10 million NPV versus $20 million NPV. And we have to demonstrate that. If not, we should distribute dividends, because distributing dividends automatically creates that capital gains that investors are looking forward to exiting with. And it also raises the value of the entity. So we are trying to kind of create that mindset where we drive more distribution of dividends to shareholders. And even talking about that, so just, I'm going to make a comment just about, we had one of my disheartening experiences earlier in my career was, I was one of the, I call myself an oil man. I grew up on the rig floor. I was there with the roughnecks, throwing tongs and everything. But How was the problem? The primitive practices of yesteryears is what is being adopted in the industry, even as we speak. The resistance to change, the resistance to new technology is being the hallmark of oil and gas industry. And we had a situation where we had to run cables earlier in my career in the Gulf of Mexico. We had to run cables all over the rig floor to connect two different systems. And run these cables, you have to run them through cable trays. Sometimes you have to run them through substructures, looking down the Gulf of Mexico, which was very risky. Now, that was the advent of Wi-Fi. I had decided that, you know what? I don't want to do this. I don't want to run the cables because guess what? In the middle of the night when they're drilling and some roughneck dumps a load on the cable and everything shuts down on the rig, then I have to come out in the middle of the night under the rain with lightning and everything and try to run the cable back into the substructure, and very risky with poor lightning. So what I did was I had to hook up the Wi-Fi, connected all the systems on the rig, and it was working perfectly. But they were not happy with that setup because they wanted to see the cable being ran. And that was almost 20 years ago. I got so much slack, I got so much heat for even putting that system in place 20 years ago. But guess what? 10 years later, it became an industry standard all over the world to use Wi-Fi connection because they felt it was safer, it was more reliable, and it keeps people from running cables along cable trays through dangerous pathways. So the industry has been stuck on primitive. They're resistant to change, but we're trying to make sure that we bring intelligent systems and bring efficiency in the value chain so that we can create better returns for our investors. Yeah, and the thing is, when we try to reimagine the entire, capital assets, capital raise, because at the end of the day, when you see what turns off investors or what turns off LPs or limited partners is when they invest about $1 million on a well. And for some reason, for somebody maybe due to structural surprises, it's a dry well. That's a total loss, a whole $1 million total loss. Now that does not bode well in the investment community when they keep seeing this happen over and over again. So we want to create a system whereby we're going to diversify we're going to create a diversified portfolio and allow fractional investing where you can invest $1,000 for this particular play in Permian. You can invest $2,000 in Marcellus. You can invest, so you write us your check for that amount of money, at least $1,000 or above, whatever you want, but less than more than $1,000. And we can now tell us what play and what portfolio you want to invest. And you invest a little at a time and you create that diversification so that at the end of the day, if you want to invest $1 million, you're not going to see a total loss. The chances of having a total loss for your $1 million will be very slim because at the end of the day, if the one in Permian comes out dry, whole, the one in Bakken or the one in Eagle Ford is going to come out with production. So we want to create that diversified portfolio that would allow investors to at least get away from having a total loss.
Okay, so the question that came in says, when you say that you can help raise capital, can you clarify? Yeah, when you say you can help raise capital, can you clarify in more details how you do that? Does the client have to have an asset, or can you help raise capital pre-getting the asset?
Okay, so we have several strategies to raise capital. First of all, we have the fund where I showed you let's go back real quick. Okay, so we have this situation where we have the fund, we create the fund, we have the low risk fund, the medium risk fund, and the high risk fund. And we allow investors to invest a minimum of $1,000 in any of the funds. And that investment fund can be used to acquire assets. But before those assets are acquired, we have to pass them through our proprietary vetting system that allows us to run them through our matrix, run them through our risk matrix, run the reservoir economics, and be able to see where to classify those assets. If it's, for example, the one I showed you, if it's a 28% internal rate of return, that falls into the medium risk bucket. And that is the bucket that investment or that investment capital is going to come from. So we're going to, if the person asking the question has an asset that they want to sell, we run it through our proprietary system that I've described, run it through the risk matrix, figure out, okay, what is that rate of return is that particular asset? And we put it in that bucket. Whether it's an Eagle Ford, it's the backing, it's Marcellus, falls into that bucket. And when it comes for capital investing, we now acquire those assets and bring that asset into our portfolio.
Anybody else? God's will. Thank you very much.
Thank you.